As the final days of 2025 ticked away, a unique atmosphere settled over Wall Street. The city's financial heart, usually pulsing with energy and urgency, began to slow its pace. The air was tinged with anticipation, as if the entire market was collectively exhaling after a year of relentless activity and dramatic swings. Wall Street grew quiet, with many traders already away for the holidays. The trading floors, once bustling with shouts and flashing screens, now echoed with a rare stillness. Offices were emptier, and the usual rush of last-minute deals faded into the background. Light volume trading set the tone, and the major U.S. stock indexes ended the year with a slight dip. The markets moved at a gentler rhythm, with fewer hands on the controls and less appetite for risk as the year drew to a close. The Dow Jones fell by just under 95 points, a modest decline that barely registered compared to the year's earlier volatility. The S&P 500 slipped by about 9, a gentle nudge downward that reflected the market's cautious mood, and the Nasdaq dropped around 55, rounding out a trio of minor losses that were more symbolic than significant. These minor declines were typical for a holiday week and reflected end-of-year profit-taking, not panic. Analysts and traders alike recognized this as a time for reflection, not reaction. Investors often sell to lock in gains before the new year, a common strategy after a strong run. It's a way to realize profits, rebalance portfolios, and prepare for whatever the next year might bring. For many, this period is about closing the books, reviewing strategies, and setting new goals. The focus shifts from chasing the next big move to consolidating what's been achieved. Think of it as a marathon runner easing up before the finish line. The main race was already won. The final stretch is about pacing, not sprinting, and making sure you cross the line strong and steady. The small dip was more about housekeeping than any new fear about the economy. It's a natural pause, a moment to tidy up accounts and prepare for a fresh start. Headlines showed red arrows, but context matters. This was the market catching its breath after an extraordinary year. The numbers in red were less a warning and more a sign of healthy, routine adjustment. The real story was the journey, not the final day's numbers. The market had weathered storms, celebrated highs, and adapted to surprises, each moment building toward this quiet conclusion. The market paused, ready to turn the page to 2026. As the lights dimmed and the last trade settled, a sense of closure and cautious optimism filled the air. It was a moment of calm, not concern, a gentle reminder that in the world of finance, every ending is just the start of a new chapter. Stepping back from the quiet finish, 2025 was a banner year for stocks. The S&P 500 surged 17 to 18%, and the Dow climbed 14%. These gains came despite global tariff disputes and geopolitical tensions. Investors showed powerful confidence in American businesses, pushing the market higher. Notably, large companies outperformed smaller ones. The Russell 2000 rose just 13%, marking the fifth year of underperformance for small caps. In uncertain times, investors favored the stability of big corporations. The bull market ran strong, with fundamentals outweighing global worries. The market weathered every storm, rewarding those who stayed invested. This set a positive tone for the year ahead. 2025 was a triumph over adversity. While stocks soared, gold quietly had its best year since 1979. Gold prices jumped over 60%, reaching around $4,344 per ounce. This rally reflected persistent anxieties. Investors hedged against inflation and global instability. Gold acts as a portfolio insurance policy, attracting buyers during uncertain times. The surge showed investors were optimistic but still cautious. Ongoing conflicts and central bank uncertainty fueled demand for something tangible. Gold's rise, alongside booming stocks, revealed a careful balance between optimism and prudence. Investors celebrated big wins but held on to security. Gold's performance was a reminder. Confidence was high, but caution remained. Silver's year was a wild ride, soaring 155%, outpacing even gold. Its path was marked by dramatic swings, attracting thrill-seeking investors. A late-year margin hike triggered an 8.7% plunge, only for silver to rebound 5.4% the next day. This volatility highlighted silver's high-risk, high-reward nature. The sharp drop and quick recovery were classic silver, unpredictable, exciting, and not for the faint of heart. Silver's massive gains made it a star performer, but with big risks. For investors, it was a roller coaster, offering spectacular returns and nerve-wracking moments. Silver was the unpredictable star of the commodities market. The secret behind the market's run? Profits. American companies delivered strong earnings, powering the bull market. The tech sector led the way, up 24.5%, with data storage and semiconductor firms like Western Digital and Micron posting triple-digit gains. Even AMD outperformed Nvidia in AI chips. The success wasn't just tech. General Motors had its best year since its IPO, and Walmart gained 24%, moving its listing to the Nasdaq. Strength was broad-based, from semiconductors to cars to retail. Investors saw companies managing costs, growing sales, and delivering profits. This widespread confidence kept buyers in the market. Strong fundamentals provided a solid floor, absorbing negative news. Profits were the engine behind the market's climb. While corporate profits soared to new heights, all eyes were fixed on the Federal Reserve, the institution at the heart of America's economic strategy. Investors, business leaders, and everyday Americans alike waited anxiously for the Fed's next move, knowing it could shape the financial landscape for months, if not years, to come. The big question on everyone's mind: would the Fed finally cut interest rates, or would it hold steady in the face of uncertainty? Inside the Fed, policymakers were deeply divided. Some argued for rate cuts to support job growth and prevent a possible downturn, believing that lower rates could help businesses expand and keep more people employed. Others, however, worried that acting too soon could reignite inflation, undoing hard-won progress. Signs of a cooling job market, like rising unemployment claims and slower hiring, pushed some officials to favor cuts, hoping to avoid a recession and keep the recovery on track. But others urged patience, pointing to stubbornly high prices in key sectors. They feared that easing up too soon could let inflation flare up again, hurting consumers and eroding purchasing power. This division at the top created a cloud of uncertainty for investors and businesses. With no clear path for rates in 2026, markets swung between hope and anxiety, trying to read every signal from the Fed. The Fed's balancing act was the central drama: cut rates too soon and risk inflation roaring back. Wait too long and risk job losses and a stalling economy. Every decision carried weighty consequences. Markets craved clarity, but the ongoing debate inside the Fed kept everyone guessing, fueling speculation and volatility across Wall Street and Main Street alike. The tightrope between economic growth and inflation defined the outlook, with every new data point scrutinized for clues about the future. As the year drew to a close, the question of interest rates remained the key issue heading into the new year, leaving the nation and the world waiting for the Fed's next move. Even as the U.S. economy thrived, global tensions cast a shadow. The Russia-Ukraine conflict remained a major concern, disrupting supply chains and energy prices. Hopes for peace faded as tensions flared, with accusations and denials deepening mistrust. Oil prices held steady at elevated levels, reflecting fears of supply disruptions. High energy costs hit consumers and businesses alike. Markets watched world events closely, knowing conflict could quickly shift the outlook. Financial markets are deeply interconnected with global events. As the year ended, unresolved conflicts remained a wild card. Investors stayed cautious, aware that global risks could disrupt positive trends. 2025's story was global. From the bustling trading floors of New York and London to the high-tech exchanges in Tokyo and Hong Kong, every region played a part in shaping the year's financial narrative. Investors and analysts watched closely as markets responded to shifting economic winds, political developments, and evolving trade relationships. Europe's STOXX 600 hit record highs, driven by strong banking and commodity sectors. Optimism surged as European economies outperformed expectations, with robust consumer spending and renewed confidence in the Eurozone's recovery. The banking sector, in particular, benefited from higher interest rates and increased lending activity. Asia was mixed. Japan's Nikkei dipped, weighed down by export challenges and a stronger yen, but the broader MSCI Asia-Pacific ex-Japan index edged up. Markets in South Korea, India, and Australia saw modest gains, reflecting resilience in technology and resource sectors despite global uncertainties. Globally, The MSCI stock gauge was nearly flat, balancing strong gains in some regions with modest results in others. This equilibrium reflected a world where growth was uneven, and investors had to navigate both opportunities and risks across continents. The US dollar saw its steepest drop in 8 years, making American goods cheaper abroad. This currency shift boosted US exports, helping manufacturers and agricultural producers reach new markets, while also impacting global commodity prices and investment flows. These shifts showed how interconnected economies are. Strong Europe helps US exporters, stable Asia supports supply chains. The ripple effects of currency and market moves were felt in boardrooms and factories worldwide, highlighting the delicate balance of global trade. Currency moves shifted trade balances and profits. Companies had to adapt quickly, hedging risks and rethinking strategies to stay competitive in a rapidly changing environment. The international picture was one of cautious strength and new dynamics. While some markets surged ahead, others paused to reassess, creating a landscape full of both promise and uncertainty. Investors faced a complex global puzzle as the year ended. They weighed geopolitical risks, inflation trends, and the potential for new growth drivers, all while keeping a close eye on shifting regulations and emerging technologies. The world's markets set the stage for 2026, with fresh challenges and opportunities on the horizon, and a renewed sense that in today's world, every market move echoes across the globe. As 2025 ended, Wall Street felt cautiously optimistic. Strong stock gains and resilient profits fueled hope for the new year. Analysts saw no signs of imminent recession, and housing data was encouraging. The labor market remained healthy, and business performance was robust. Optimism hinged on the Fed's ability to cut rates without reigniting inflation. But risks lingered. Geopolitical tensions and Fed divisions kept uncertainty high. The outlook was a balance: strong fundamentals versus real risks. Investors entered 2026 hopeful but vigilant. The market's resilience in 2025 inspired confidence, the hope that strength would carry into the year ahead.